It is officially over. For years, we have sat here and speculated. We have looked at the charts, we have looked at the open interest, and we have guessed. We have said, one day the banks will break. We have said, one day the naked shorts will get caught offside so badly that the entire financial system will have to bend the knee. We have hypothesized that the bullion banks are leveraged to the hilt, playing a dangerous game of fractional reserve paper trading against a physical asset that is running out. But up until this morning, that was just a theory. It was a mathematical probability, sure, but we didn't have the smoking gun. We didn't have the body. Well, stop guessing. Stop speculating. Because that day is today. The body has been found. Ladies and gentlemen, Asian guy here, while you were glued to your screens watching the spot price of silver hit $77.16, while you were celebrating the breakout and calculating your net worth, something much more important, much darker, and much more terrifying was happening in the plumbing of the global financial system. Something that the mainstream media is terrified to report because it proves, without a shadow of a doubt, that the banking system is insolvent. We just received the official data from the Federal Reserve Bank of New York regarding their overnight reverse repurchase agreements, the repo facility, for this morning, Friday, December 26th. And the number that just flashed across the terminal is not a typo. It is not an error. It is a confession. $17,251 million. In a single morning, in the quiet hours just after the Christmas holiday, the too big to fail banks tapped the Federal Reserve's emergency liquidity window for over $17 billion in cash. Now, you need to understand what this means. You need to understand what the repo market actually is. This is not the window where healthy banks go to get a loan to expand their business. This is not where you go to get capital for a new project. The repo facility is the pawn shop of the last resort. It is the emergency room for a heart attack. If you are a healthy bank with a balanced book, you do not touch the repo facility. You trade in the interbank market. You borrow from your peers. It is a badge of honor to avoid the Fed's window because going there is a signal of weakness. It is the walk of shame of the banking world. So, why would the masters of the universe, the entities that supposedly control the global economy, need $17 billion in cash at 8 o'clock a.m. on the day after Christmas? Is it for payroll? No. Is it for operational expenses? No. They need it because they are bleeding to death. They need it because they just received the biggest margin call in the history of the commodities markets. Connect the dots. Look at the timing. It is impeccable. Yesterday, silver gapped up. Overnight, it teleported to $77. The banks are sitting on short positions that number in the hundreds of millions of ounces. They sold those contracts at $30. They sold them at $50. They sold them at $70, thinking they could tamp it down like they always do. They thought they could spook the retail investors, trigger the stops, and buy it back cheaper. But the retail investors didn't sell. The Chinese industrial buyers didn't sell. The vaults were empty. The price didn't go down. It went vertical. And right now, silver is trading at $77.16. Do the math. Every single dollar that silver rises creates billions of dollars in losses on their books. But there is a difference between unrealized losses and a margin call. For months, the banks have been hiding these losses. They mark them as unrealized. They pretend that the price will come back down, so they don't have to acknowledge the hole in their balance sheet. They kick the can down the road. But the COMEX clearinghouse doesn't care about your accounting tricks. The exchange doesn't care if you think the price will go down next week. The exchange cares about solvency right now. When the price moves $5 against you in 24 hours, the clearinghouse computer spits out a number. It says, you're underwater. Post the cash to cover the risk, or we liquidate your position. This morning, that computer spat out a number, and that number was evidently $17 billion. The clearinghouse called the banks and said, pay up. And the banks looked at their ledgers, looked at their liquid cash reserves, and realized the terrifying truth. They didn't have it. They are illiquid. They are insolvent on a mark-to-market basis. So they had no choice. They gathered up their U.S. Treasury bonds, the only collateral they have left, and they ran to the Federal Reserve. They pawned their treasuries for overnight cash just to keep the lights on, just to prevent the clearinghouse from forcibly closing their short positions and sending the price of silver to $200 instantly. This $17 billion is not a stimulus check. It is a tourniquet. It is a desperate attempt to stop the bleeding before the patient dies on the table. And think about the day. It's Friday. In the banking world, bad news is always buried on a Friday. Banks fail on Fridays. Regulators seize assets on Fridays. The fact that this liquidity spike happened on the Friday after Christmas, when nobody was supposed to be watching, tells you everything you need to know about the severity of the crisis. They were hoping this would slip under the radar. They were hoping that the volume would be low enough that nobody would notice the Fed printing $17 billion to bail out a silver short. But we noticed. We are watching. And what we are seeing is the breakdown of the suppression machine. For decades, the scheme worked like this. The banks sell paper silver to push the price down. If the price rises, they sell more paper. They have infinite paper, so they can always win. But the one thing that kills that scheme is a liquidity crisis. If you run out of cash to post margin for your new shorts, you can't sell anymore. You lose your ammunition. The $17 billion represents the bottom of the barrel. It represents the moment where the banks ran out of their own money and had to start using the taxpayers' money, via the Fed, to fight the market. This changes the entire dynamic of the trade. We are no longer fighting JP Morgan or Citi. We are now fighting the Federal Reserve directly. The Fed has stepped in to become the counterparty. They are effectively subsidizing the short position. But here's the catch. Even the Fed cannot print physical silver. They can print dollars to keep the banks alive, but they cannot print the metal to deliver into the Chinese market. In fact, this bailout makes the situation worse. Think about it. The banks needed cash because the dollar is losing value against silver. The Fed's solution? Print more dollars. Inject $17 billion new dollars into the system. What does that do? It devalues the dollar even further. It adds more fuel to the inflation fire. It validates the exact thesis that is driving silver higher. It is a self-defeating feedback loop. The more they bail out the shorts, the higher the price goes. The higher the price goes, the bigger the bailout needs to be. We are watching the beginning of a hyperinflationary melt-up, localized specifically in the commodities market. The banking system has inadvertently trapped itself. They cannot let the price rise or they go bankrupt. But they cannot stop the price from rising without printing money, which makes the price rise faster. This $17 billion is just the first tranche. It is the tip of the iceberg. If silver goes to $80, which could happen before the market closes today, that $17 billion won't be enough. They will need $20 billion, then $30 billion. We are going to see the repo market explode just like it did in September 2019, right before the global financial system seized up. Remember September 2019? The repo rate spiked, the Fed panicked, and a few months later they flooded the world with liquidity. We are seeing the exact same pattern repeat, but the trigger this time isn't a nebulous interbank lending freeze. The trigger is specific. The trigger is silver. The trigger is a hard asset rebellion against paper promises. The skeptics will say, oh, $17 billion is nothing compared to the global economy. Wrong. In the leverage-heavy world of futures trading, $17 billion of margin represents hundreds of billions of dollars of notional exposure. That isn't a small leak. That is the hull of the Titanic ripping open. That is a systemic failure event. And notice who tapped the facility. The data is anonymized, but we know who the players are. It wasn't the regional banks. Small banks don't have massive short positions in silver futures. This was the G-SIBs, the global systemically important banks. The whales. The very entities that told you silver was a pet rock are now pawning the family silver, or rather, the family treasuries, to survive the pet rock's revenge. This is the ultimate vindication for every stacker, every silver bug, every person who has held physical metal through the years of ridicule. You were right. You broke them. You held the line while they leveraged themselves into oblivion, and now the bill has come due. The $17 billion is the receipt. It is the proof that they are terrified. And do not let anyone gaslight you into thinking this is normal year-end maneuvering. Year-end window dressing happens, yes. But it happens in the open market. It doesn't happen at the emergency repo window to the tune of $17 billion on a day when silver is ripping 5%. The correlation is 1.0. This is a margin call. Plain and simple. So what happens next? If they needed $17 billion at $77, what happens at $85? What happens at $100? The Fed cannot keep this secret. As the repo numbers climb, the confidence in the banking system will erode. We are looking at a potential banking crisis that starts not with bad mortgages, not with tech stocks, but with a short squeeze in the monetary metals. We have moved past the point of market correction. We are in the phase of systemic rescue. The Fed is now actively managing the silver price, not by selling metal, but by keeping the shorts on life support. But a patient on life support cannot fight a war. The banks are incapacitated. They are zombie institutions now, existing only because of the Fed's drip feed. And zombies cannot stop a bull market. They can only watch it happen. The suppression is effectively over because the suppressors are bankrupt. They are out of ammo. All they have left is the Fed's credit card. And they just maxed out the first limit. This $17 billion lifeline proves that the unlimited supply of paper silver has hit a hard wall. That wall is liquidity. You can print infinite contracts, but you cannot print infinite margin cash without destroying the currency. They have reached the limit of their leverage. The game is mathematically over. And do not let the sterile language of repo and liquidity operations bore you. I need you to understand the raw, brutal mathematics of what is happening to these banks right now. We are talking about leverage. We are talking about the kind of financial leverage that turns a small mistake into a nuclear detonation. You have to remember how the COMEX works. One single futures contract represents 5,000 ounces of silver. When a bank sells that contract, they are promising to deliver 5,000 ounces, but they only have to put up a tiny fraction of the value in cash, usually about 10 or 15%. This is the margin. It allows them to control massive amounts of silver with very little money. It is the secret to their power. It is how they have suppressed the price for 40 years by selling paper promises they couldn't possibly fulfill. But leverage cuts both ways. Let's run the numbers on a hypothetical too-big-to-fail bank. Let's say they are short just 10,000 contracts. In the grand scheme of the bullion banks, that is a conservative estimate. 10,000 contracts times 5,000 ounces is 50 million ounces of silver. If silver moves up by just $1, that bank loses $50 million. $1 move, 50 million loss. Now, look at what happened in the last 24 hours. Silver didn't move $1, it moved $5. It gapped from $72 to $77. That means that single bank on that single position lost $250 million before they could even finish their morning coffee. And that is just one bank. When you aggregate the entire commercial short position, the 4 big US banks and the 4 big international banks, we're talking about hundreds of millions of ounces short. We're talking about billions of dollars in losses accumulating in real time. And here is the trap, the unrealized trap. Bank CEOs love to go on CNBC and say, oh, these are just paper losses. We haven't closed the trade. The price will come back down and we will be fine. They treat the market like a casino where they can just wait for the roulette wheel to spin their way again. But the clearinghouse is the pit boss. And the pit boss doesn't care about your long-term strategy. The pit boss cares about the chips on the table right now. This is called mark-to-market accounting. Every night, the exchange calculates the value of every position. If the price goes against you, they don't wait for you to close the trade. They reach into your account and take the cash to cover the difference. So when silver hit $77 this morning, it wasn't just a bad day for the banks, it was a liquidation event. The $77 price point is critical because it is the mathematical point of no return for their risk models. At $77, the losses exceed the cash buffers they keep on hand for daily operations. Their internal value at risk, VAR models, blew up. The red lights started flashing in the risk management offices. That is why they needed the $17 billion. It wasn't to pay off the loan, it was just to stay in the game. It was the ante to keep the clearinghouse from seizing their assets. We are witnessing technical insolvency. If these banks had to liquidate their entire short position today, if they had to buy back every ounce they owe at $77, they would be bankrupt. Their equity would be wiped out. They are zombies walking around with a pulse provided by the Federal Reserve, pretending they are still masters of the universe. But here's the thing about math. It is cold, it is unyielding, and it doesn't care about the Fed. The $17 billion buys them time. It buys them another day, but it doesn't solve the problem. Because the problem isn't cash. You can print cash. The Fed can print 17 trillion if they want to. The problem is the metal. The clearinghouse demands cash for margin, but the contract holder, the person on the other side of the trade who bought that contract, they don't want cash anymore. They saw the news from Venezuela. They saw the Shanghai price. They don't want a settlement check. They want the 5,000 ounces. And this is where the math of insolvency turns into the physics of impossibility. Because while the Fed can wire $17 billion in a nanosecond, they cannot print 63 million ounces of silver. And that is exactly what the market is demanding right now. We have moved from a financial crisis to a delivery crisis, and the numbers coming out of the COMEX delivery report are staggering. But do not let the sterile language of repo and liquidity operations bore you. I need you to understand that the $17 billion is just the admission fee. It is the cost of staying alive in the casino. But staying alive doesn't matter if you can't pay the winner. And right now, the winners, the entities holding long futures contracts, are not asking for chips. They're asking for the silver. We have moved from a financial crisis to a delivery crisis. And the numbers coming out of the COMEX delivery report are staggering. This morning, the CME Group released the daily delivery notice report for December. Usually, December is a quiet month. Traders roll their contracts to March or settle for cash. But this December is different. This December is a run on the bank. We are seeing a total of 12,707 delivery notices issued for the month. Now, to a layman, that sounds like a random number, but let me translate that for you. One contract is 5,000 ounces. 12,707 contracts is 63,535,000 ounces of silver. Let that sink in. Over 63 million ounces of physical metal are currently standing for delivery in New York. That is roughly 8% of the entire annual global mining supply, demanded in a single month from a single exchange during a holiday week. In a normal market, this number is a fraction of that. Usually, the open interest collapses as the contract expires because nobody actually wants 5,000 ounces of silver dropped on their driveway. Hedge funds trade paper for profit, not for metal. But the behavior has shifted. The longs are not rolling over. They are holding the contract to expiration and demanding the warrant. This is the industrial panic we warned you about. The entities behind these contracts are not speculators. They are supply chain managers. They are battery manufacturers. They are sovereign wealth funds. They look at the deficit, they look at the Venezuela blockade, and they say, I don't want your cash is melting. I want the metal. And here is where the panic sets in for the banks. They don't have it. If you look at the registered category in the COMEX vaults, the metal that is actually available to be delivered against these contracts, it has been bleeding dry for months. We tracked the Asahi drain. We tracked the JP Morgan drain. The registered inventory is hovering near historic lows. So you have a demand for 63.5 million ounces. But the vaults are effectively empty of unencumbered metal. So how do the banks fulfill these delivery notices? They have to go into the open market and buy it. They have to become emergency buyers in a market that is already hitting all-time highs. Imagine being a bank that is short silver. You're losing money every second. And now, to settle your trade, you have to go out and buy physical silver at $77, $78, or the $80 to hand it over to the person who beat you. This buying pressure acts as rocket fuel for the price. It is forced buying. It is price inelastic buying. And it gets darker. We are hearing rumors, and the data supports this, that the banks are beginning to cannibalize the ETFs to find the metal. They are looking at the massive stockpiles held by SLV and SIVR and trying to use authorized participant loopholes to drain that metal and move it to the COMEX to satisfy delivery. They are robbing Peter to pay Paul, but Peter is watching. The ETF holders are watching. If they raid the ETFs to bail out the COMEX, the ETF price will disconnect and the shareholders will sue. It is a legal minefield. So, the $17 billion from the Fed solves the cash problem, but it does not solve the 63.5 million ounce problem. You cannot print a silver bar. You cannot digitally create an industrial commodity. The only way to solve this imbalance is for the price to rise high enough that people stop asking for delivery. But at $77, the demand is increasing. At $80, the demand will likely increase more because the FOMO, fear of missing out, kicks in. We are in a Giffen good scenario. Usually when price goes up, demand goes down. But for a strategic asset in a shortage, when price goes up, demand goes up because people realize it is running out. The 12,707 contracts standing for delivery are proof that the price is not high enough to ration demand. It is too cheap. $77 is too cheap. If it were expensive, people would be selling. Instead, they are taking delivery of 63 million ounces. This is the break the exchange moment. If the COMEX fails to deliver, if just one of those contracts defaults, it is game over. The exchange will declare force majeure. They will force settle in cash, and the moment they do that, the price of physical silver in the real world will decouple completely from the paper price. You will see paper silver at $80 and physical silver at $150. The 12,707 notices are the countdown clock, tick-tock. And speaking of robbing Peter to pay Paul, we need to talk about the strange anomaly that happened with the SLV ETF today. Because if you don't understand how the plumbing of the paper market works, you are going to misinterpret the data. You are going to look at the headlines and think the pressure is easing, when in reality, the pressure has just become terminal. We saw a headline cross the Bloomberg terminal this afternoon that confused a lot of retail traders. The borrow fee for SLV, the cost that hedge funds pay to borrow shares so they can short the price, dropped. It fell from over 1.5% on Tuesday down to 0.62% today. At the same time, we saw 10 million new shares of SLV suddenly become available for borrowing. Now, the mainstream financial media, the pundits on CNBC, who have been telling you to sell silver for the last 3 years, immediately jumped on this. They said, look, the borrow fee is dropping. That means the squeeze is over. That means there is plenty of liquidity. That means the shorts are comfortable. They want you to believe that a lower cost to borrow means the market is returning to normal, that the supply of paper silver is flooding back in to cool off the rally. They are lying to you. Or perhaps more charitably, they are fundamentally incompetent and do not understand the mechanics of a capitulation event. Let me explain what a drop in borrow fees actually means in this specific context. The borrow fee is a function of supply and demand. It is the price of renting the stock. If everyone wants to short SLV, if every hedge fund in Greenwich is lining up to bet against silver, the demand for borrowed shares goes through the roof and the fee spikes to 10%, 20%, or higher. We saw that happen with GameStop. We saw that happen with AMC. A high borrow fee means the battle is raging. It means the shorts are fighting tooth and nail to hold the line, and they are willing to pay a premium to keep their bearish bets open. But What does it mean when the fee collapses? What does it mean when the cost to borrow drops to practically zero in the middle of a historic rally? It means the shorts have left the building. It means that the demand for borrowing shares has evaporated. Why? Because nobody is stupid enough to short silver right now. The hedge funds have done the math. They see the $17 billion repo spike. They see the 63 million ounce delivery demand. They see the U.S. Navy boarding tankers in the Caribbean. And they have decided that shorting silver at $77 is a suicide mission. So they are returning the borrowed shares. They are closing their positions. They are covering. When they cover, they return the stock to the lender. This floods the lending pool with available shares. Hence the 10 million shares available headline. And because there are no new short sellers stepping in to take their place, the fee crashes. This is not a sign of bearish strength. This is a sign of bullish victory. It is the white flag. The short army has disbanded. They have looked at the battlefield, seen the physical carnage, and they have retreated. Think about the psychological shift that represents. For 40 years, whenever silver spiked, the smart money would short it. They knew the banks would smash the price. It was a reflexive, conditioned response. Silver is up $2, short it, easy money. But today, with silver up $5, the borrow fee dropped. That tells you that the reflex is broken. The smart money is terrified to step in front of this freight train. They know that the Fed is now involved. They know that shorting silver today isn't fighting a mining company. It's fighting the printing press of the United States and the strategic reserves of China. There is no alpha in that trade. There is only bankruptcy. So the speculators have capitulated. They are standing aside. And without the speculators piling on the short side, who is left to stop the price from rising? Nobody. The dampening mechanism is gone. The friction is gone. This is why we are seeing these air pockets to the upside. In a normal market, as price rises, short sellers step in to fade the move, providing liquidity and slowing the ascent. Today, the price rose $5 and nobody stepped in. The liquidity vacuum on the sell side is absolute. And let's look at those 10 million shares available again. Where did they come from? In the ETF world, shares are created and destroyed by authorized participants, the big banks, based on demand. If investors are selling SLV to buy physical metal, which we know they are, given the premium disparity, the ETF shrinks. The basket is broken down. But sometimes in a chaotic market, we see weird flows. One possibility, and this is consistent with the cannibalization theory, is that the authorized participants are creating new SLV shares not backed by real metal, but by leased metal or paper credits, specifically to lend them out to desperate market makers who need to hedge their options exposure. They are printing paper to cover a paper disaster, but even if they print the shares, nobody wants to borrow them to go short. That is the key. You can lead a horse to water, but you can't make him short a monetary metal during a hyperinflationary collapse. This drop in the borrow fee effectively removes the ceiling of the market. As long as there were aggressive shorts, there was a potential for a short squeeze in the traditional sense, a violent pop followed by a crash. But what we are entering now is something different. It is a vacuum squeeze. It is a market where the sellers simply disappear. It is a repricing event. If you are a holder of SLV, this should validate your thesis, but it should also worry you about the vehicle you are holding. If the shorts are gone, that's good for the price. But if the authorized participants are playing games with the share count to manage liquidity during a crisis, the tracking error of the ETF is going to blow out. We are already seeing SLV lag the spot price slightly. We are seeing SLV lag the physical coin price massively. The smart money isn't just closing shorts, they are rotating. They are closing their SLV shorts and, in many cases, flipping long into the miners or the physical metal. That explains the 50% move in the junior miners today. The capital that used to be used to suppress the price is now being used to chase the price. The energy has reversed direction. So, when you see that headline, SLV borrow fee drops, do not let the gaslighting fool you. Do not let them tell you the squeeze is over. The squeeze has evolved. The short squeeze phase, where we force them to cover, is transitioning into the buyer's panic phase, where everyone tries to get in at once. The shorts covering is what gave us the move to $77. They are largely out now. They have taken their losses and fled. The next leg of the move to $100, won't be driven by shorts covering. It will be driven by new money entering. It will be driven by the pension funds, the sovereign wealth funds, and the retail public waking up to the reality that the banks have surrendered. The retreat of the shorts removes the last line of defense for the fiat currency. As long as speculators were willing to short silver, they were effectively defending the dollar. They were betting that the dollar would hold its value against the metal. By walking away, they are admitting that the dollar is undefendable. They are admitting that the Fed's $17 billion injection is inflationary and that they do not want to be on the wrong side of it. This clears the runway. It leaves the market purely to the physical fundamentals. And as we discussed in the previous section with the delivery notices, the physical fundamentals are catastrophic for the consumer and ecstatic for the investor. The demand is vertical and the supply is zero. Now we have to talk about the contagion. Because if the shorts have capitulated and the banks have tapped the repo window and the physical delivery mechanism is breaking down, this cannot be contained to the silver market. Silver is the canary in the coal mine, but the gas is already filling the room. Why did the Fed step in so fast with that $17 billion? Was it just to save a few trading desks? No, they stepped in because they know the history. They know that in 1980, the silver crisis threatened to take down the brokerage houses. They know that in 2008, the commodity collapse triggered the margin calls that exposed the subprime rot. The financial system is a daisy chain of leverage. If one major bullion bank fails to meet a margin call on silver, they default to the clearinghouse. If they default to the clearinghouse has to draw on the default fund. That fund is capitalized by the other banks. If the hole is big enough, and at $77 silver the hole is the size of a crater, the contagion spreads instantly. JP Morgan is counterparty to Citi. Citi is counterparty to HSBC. If one domino falls, they all fall. The Fed knows this. They saw the internal risk reports. They saw that a failure in the metals desk would trigger cross defaults in the interest rate swap market and the currency derivatives market. Silver is the small cog that turns the big wheel. If the small cog shatters, the machine stops. So, the Fed had a binary choice this morning. Choice A, let the free market work. Let the banks who made bad bets fail. Let the price of silver find its true equilibrium, even if it bankrupts the too-big-to-fail institutions. Choice B, print the money, bail them out, destroy the credibility of the currency to save the structure of the banking system. They chose choice B. They always choose choice B. But there is a consequence. By printing $17 billion to suppress a crisis caused by inflation and currency debasement, they have just guaranteed more inflation and more currency debasement. They are trying to put out a fire with gasoline. This $17 billion injection is the signal that we are back to QE infinity. They might not call it that. They might call it temporary liquidity operations. But we know what it is. It is money printing, and the market knows what it is. That is why the junior miners are up 50%. The equity market is sniffing out the pivot. They realize that the Fed has just put a floor under the system. The Fed has effectively said, we will not let the banks fail due to a commodity squeeze. And the only way to honor that promise is to print unlimited amounts of cash. This means the Fed put, the safety net that usually supports the stock market, is now supporting the silver price. If silver dips, the banks get into trouble again and the Fed prints more. If silver rips, the banks get into trouble and the Fed prints more. All roads lead to the printing press. This removes the downside risk for silver investors. The worst case scenario isn't a crash, it's a bailout. And a bailout is bullish for hard assets. So, the capitulation of the shorts in SLV and the intervention of the Fed in the repo market are two sides of the same coin. They are both admissions that the system cannot handle fair market prices. The shorts ran away because the game is broken. The Fed stepped in because the game was about to end. But by stepping in, they have sealed the fate of the dollar. They have confirmed to the world, to China, to Russia, to the BRICS, that the U.S. banking system is dangerously fragile, and that the U.S. dollar is being diluted to keep it alive. This accelerates the geopolitical move away from the dollar. It validates the blockade narrative. It validates the war metal thesis. We are watching the death of the old financial order in real time. The borrow fee dropping is just the sound of the rats jumping off the ship. The repo spike is the sound of the captain trying to bail out the water. But the hull is breached. The 63 million ounces of physical demand is the iceberg, and we have already hit it. And this brings us to the final realization of what comes next. If the Fed is back in the game, if the shorts are gone, and if the delivery demand is breaking records, then the price targets we talked about earlier, the $80, the $100, are now backed by the full faith and credit of the Federal Reserve's printing press. We are not just riding a supply shortage anymore. We are riding a monetary devaluation event. The pivot has arrived. It didn't come with a press conference and a fancy speech from the chairman. It came with a desperate $17 billion wire transfer on the Friday after Christmas. But the result is the same. The liquidity gates are open, the dollar is being sacrificed, and silver is the chosen vessel for the wealth transfer that is about to take place. The $100 roadmap is no longer speculation. It is a policy certainty. Because the alternative is a systemic collapse that the Fed has proven today, they will pay any price to avoid, and that price will be paid in the value of your fiat currency, pushing the nominal price of real things to the moon. So buckle up. The shorts are out, the Fed is in, and the rocket has been cleared for launch. Now, let's look at exactly how this plays out next week when the big money returns to a market that has just been guaranteed by the central bank. Because you have to ask yourself, Why would the Federal Reserve, the most powerful economic institution on earth, care about a few $1 billion lost on a shiny metal? Why would they debase their own currency and risk their credibility to save a handful of trading desks from a bad bet? The answer lies in the terrifying architecture of the modern financial system. We are not living in a world of separate siloed markets anymore. We are living in a world of daisy-chained leverage, where every asset class is inextricably linked to every other asset class through the dark magic of derivatives. The mainstream media treats silver like a niche asset. They call it a commodity. But to the banks, silver is not a commodity. It is a financial collateral tier. It is a foundational block in a tower of rehypothecated value. The banks didn't just sell paper silver once. They leased it, swapped it, bundled it, and used it as collateral to borrow money to bet on treasuries, or yen, or tech stocks. This is the contagion nightmare that woke up the Fed governors this morning. If a major bullion bank, let's call them Bank X, cannot meet a margin call on silver, they default to the COMEX clearinghouse. The moment that default happens, the clearinghouse has the legal right to seize all of Bank X's collateral. That means they seize their treasury bonds, they seize their corporate bonds, they seize their cash. Now, imagine Bank X is also the counterparty for $1 trillion in interest rate swaps with a pension fund. Suddenly, Bank X is frozen. The pension fund can't hedge its risk. The pension fund panics and sells bonds. The bond market crashes. When the bond market crashes, the collateral for the other banks loses value. Now, Bank Y gets a margin call. It is a domino effect. It is 2008 all over again. But this time, the toxic asset isn't subprime mortgages. It is a naked short position in a strategic metal that is in a physical shortage. The Fed stepped in with that $17 billion because they looked at the internal risk monitors and saw the red zone. They saw that a failure in the commodities division of a GSIB, global systemically important bank, threatened to lock up the repo market for everyone. They realized that the silver squeeze wasn't just squeezing the shorts, it was squeezing the liquidity of the entire U.S. banking sector. They had a binary choice, and it is the same choice they have faced in every crisis since 1987. Choice A, allow the free market to function. Let the banks who manage their risk poorly fail, let the shareholders get wiped out, let the price of silver reset to $200 overnight, creating a chaotic but honest market. Choice B, intervene, print the money, provide the liquidity, save the banks but destroy the signal. They chose choice B. They always choose choice B. They chose to sacrifice the integrity of the dollar to save the structure of the banks. But here is the fatal flaw in their logic. Here is the doom loop that they have just trapped themselves in. By printing $17 billion to bail out the system from a silver squeeze, they have just poured jet fuel on the inflation fire. Think about the signal this sends to the rest of the world. The US dollar is supposed to be the risk-free asset. But today, the Fed admitted that the banking system backing that dollar is so fragile that a $5 move in silver threatens its solvency. They admitted that they have to print money to prevent a deflationary bust. What happens when you print money? The currency devalues. What happens when the currency devalues? Hard assets go up in price. What happens when hard assets go up in price? The bank's short positions get worse. Do you see the trap? The very act of saving the banks makes the silver price go higher. To save them today at $77, they printed $17 billion. That printing will push silver to $85 next week. So next week, they will have to print $25 billion. That printing will push silver to $95. It is a self-defeating feedback loop. They are trying to put out a fire by smothering it with cash, but cash is flammable. They are caught in a liquidity trap of their own making. They cannot stop printing because the system will collapse, but they cannot keep printing because the currency will collapse. And the market knows this. The smart money, the real smart money, not the hedge fund guys borrowing SLV, but the macro allocators who run sovereign wealth funds, they are watching this repo spike and they are terrified. They realize that the Fed put has shifted. For 20 years, the Fed put was under the stock market. If stocks crashed, the Fed printed. Today, the Fed effectively placed a put under the silver price. By bailing out the shorts, they have capped the downside. They have proven that they will provide infinite liquidity to the system to prevent a blowout. This means that if you own silver, the Central Bank of the United States is effectively subsidizing your risk. If the price drops, the physical shortage takes over. If the price rips and breaks the banks, the Fed prints money, causing inflation, which drives the price back up. It is a heads I win, tails you lose scenario for the silver holder. This realization is what drove the 50% gains in the junior miners today. The equity market is a forward-looking machine. It is pricing in the pivot. The Fed hasn't held a press conference. Jerome Powell hasn't stood at the podium. But actions speak louder than words. A $17 billion emergency repo operation is the pivot. It is the restart of QE infinity in everything but name. And we have to talk about what this means for the too big to fail concept. By tapping this facility, the bullion banks have effectively become wards of the state. They are no longer independent capitalist entities. They are zombie utilities, kept alive by the state to facilitate the flow of credit. This means that the suppression of the silver price is no longer a private conspiracy. It is a state-sponsored operation, but it is a failed operation. History is littered with examples of governments trying to peg the price of commodities. The London Gold Pool in the 1960s, the Nixon price controls in the 1970s. Every single time the market wins. Every single time the physical reality overwhelms the paper mandate. The London Gold Pool collapsed in 1968 when the run on gold drained the vaults. We are watching the New York Silver Pool collapse in 2025 as the run on silver drains the COMEX. The mechanism is identical, the hubris is identical, and the outcome will be identical: a violent, chaotic repricing of the metal to a level where the demand matches the supply. And the contagion isn't just financial, it's psychological. Trust is the currency of the banking system. When a bank taps the repo facility, trust evaporates. Other banks stop lending to them. Counterparties demand higher margin. This tightens financial conditions across the globe. This is why we saw the dollar index, DXY, tank today, despite the flight to safety narrative. Usually in a crisis, the dollar rises. But today, the dollar fell. Why? Because the market realized the crisis is the dollar itself. The crisis is the solvency of the issuers of the dollar. Investors are looking at the U.S. debt, $38 trillion and counting. They are looking at the interest payments, $2 trillion a year. And now they are looking at the Fed printing money to bail out commodity speculators. They are connecting the dots. They are realizing that the only way out of this debt trap is to inflate it away. Silver is the only lifeboat that cannot be diluted. You can dilute the dollar. You can dilute the euro. You can even dilute Bitcoin with forks and thousands of altcoins. But you cannot dilute silver. It is atomic element number 47. It is forged in supernovas. There is a fixed amount on the crust of the earth, and we have already mined the easy stuff. So, the contagion spreading through the banks is actually the antibodies of the free market attacking the virus of fiat currency. The system is trying to heal itself. The fever of high prices is the cure. High prices stimulate supply and ration demand. The Fed is trying to suppress the fever, but the patient is too sick. And this brings us to the geopolitical angle of the contagion. Do you think Beijing didn't see that repo print? Do you think Moscow missed it? They are watching the U.S. banking system bleed. This validates their strategy. It encourages them to press the advantage. If you know your opponent is illiquid, if you know they are desperate for cash, do you ease up? No, you double down. You buy more physical metal. You tighten the blockade. You squeeze them until they break. The $17 billion today didn't just save a few banks. It signaled weakness to America's geopolitical rivals. It told them that the U.S. financial shield is cracked. This guarantees that the war on shipping and the war on commodities will escalate. China knows that if they can keep the price of silver above $80 for another week, they can force the Fed to print another $50 billion. If they push it to $90, maybe they can force $100 billion. They can force the U.S. to hyperinflate its own currency just to keep the banks alive. It is financial warfare 101, and the Fed just walked right into the trap. So, as we transition to the final part of this report, you need to understand that the $100 price target isn't just about charts or supply deficits anymore. It is about a fundamental shift in the monetary regime. We have crossed the Rubicon. The Fed is now the buyer of last resort for the bank's bad silver bets. And because the Fed has infinite dollars but zero silver, the price of silver has to rise to infinity in dollar terms to balance the equation. The $17 billion was the all-in moment. The Fed pushed its chips into the center of the table, but the market holds the royal flush. The market holds the physical metal. And in the final part, I'm going to tell you exactly how to play this hand. I'm going to give you the roadmap for the inevitable move to triple digits and how you can position yourself to be on the receiving end of the greatest wealth transfer in history rather than the victim of it. The Fed pivot is here. The game has changed, and the price is about to reflect the new reality. The $17 billion wire transfer was the all-in moment. The Federal Reserve pushed its chips into the center of the table, but the market holds the royal flush. The market holds the physical metal, and the Fed holds nothing but a printing press that is rapidly losing its power to command respect. We have arrived at the conclusion of this report, but really, we have arrived at the beginning of a new monetary epoch. The events of this morning, the panic in the repo market, the capitulation of the shorts in SLV, the record-breaking delivery demands, have confirmed the one thing that every gold and silver investor has been waiting for: the pivot. For 2 years, the mainstream financial media has obsessed over the pivot. They asked, when will Jerome Powell cut rates? When will they stop tightening? They thought the pivot would come with a press conference. They thought it would come with a polite adjustment to the dot plot. They were looking for a ceremony. Instead, the pivot arrived in the dark. It arrived as a desperate $17 billion liquidity injection to save a banking system that is choking on its own leverage. This is the pivot. When the central bank is forced to print money to prevent a systemic collapse caused by a commodity squeeze, the tightening cycle is mathematically over. They cannot fight inflation and bail out the banks at the same time. They have chosen the banks. And by choosing the banks, they have surrendered to inflation. This changes the calculus for silver entirely. We are no longer just looking at a supply-demand deficit. We are looking at a currency devaluation event. The Fed put, that magical safety net that investors believe protects the stock market, has now been placed firmly under the silver price. Think about the implications. If silver crashes tomorrow, the bank's collateral problems might ease temporarily, but the underlying physical shortage remains. The squeeze just rebuilds. But if silver rips higher, which it is doing, the banks face insolvency and the Fed is forced to print. This printing devalues the dollar, which makes silver, a dollar-denominated asset, go even higher. The Fed has inadvertently created a mechanism where their own survival reflex pushes the price of precious metals to the moon. They are trapped in a room with shrinking walls. To save the system, they must destroy the currency. And as the currency is destroyed, the nominal price of real things must rise to infinity to compensate. This is why my price target of $100 is no longer a speculation based on industrial usage or mining deficits. It is a policy certainty. It is the mathematical output of the equation the Fed just wrote. If they have to print hundreds of billions, eventually trillions, to keep the repo market liquid and the derivatives complex from detonating, then silver at $100 is actually cheap. In a hyperinflationary liquidity cycle, $100 is the new $20. So, what is the roadmap for the next few weeks? How do we navigate this endgame scenario? First, you must understand that the volatility will be extreme. The beast is wounded, but it is not dead. The banks, armed with their fresh $17 billion of Fed liquidity, might try one last desperate smash. They might try to use that cash to short the market into oblivion on Monday morning to break the psychology of the retail investor. Do not let them. If you see the paper price drop $10 in a flash crash, do not panic. Smile. Realize that this is the death throes of a broken system. Realize that every time they smash the paper price, they are just making the physical metal cheaper for China, for India, and for the savvy investors who are draining the vaults. A paper smash and a physical shortage is like putting a sale sign on an empty shelf. It doesn't create inventory, it just accelerates the panic. Second, watch the basis. The basis is the difference between the futures price and the spot price. In a healthy market, futures trade higher than spot, contango. In a shortage, spot trades higher than futures, backwardation. We are already seeing backwardation in the near months. When you see the spot price rip away from the futures price, when you see dealers charging $10, $15, $20 over spot, that is the real price. The screen price is a lie. The street price is the truth. Follow the truth. Third, and most importantly, prepare for the unobtainium phase. We are very close to the moment where the major dealers simply run out of stock. The 12,707 delivery notices are sucking the wholesale market dry. Once the wholesalers are empty, the retail shelves go bare. The buy button will disappear. When that happens, the price will effectively become infinity for anyone who isn't already holding. You won't be able to get in. The doors will close. We are seeing early signs of this already, with delays stretching to February for certain sovereign coins. If you are sitting on cash, waiting for a dip, you're playing Russian roulette with a fully loaded gun. The risk isn't that you buy too high. The risk is that you can't buy at all. This brings us to the final strategic conclusion. We are witnessing the greatest wealth transfer in history, but wealth is not destroyed, it is merely transferred. It is transferring from those who hold paper promises, bonds, currencies, derivatives, to those who hold real things. For 40 years, the flow went one way, from the real to the financial. The financial economy cannibalized the real economy. Now, the tide has turned. The real economy is devouring the financial economy. The miners, the stackers, the holders of physical assets, you are the new captains of capital. The banks are insolvent, the Fed is trapped, the vaults are empty. The war is escalating. The shorts have fled. The stars have aligned in a way that happens once in a century. Do not sell your position for fiat currency that is being printed to bail out your enemies. Hold the line. When silver hits $100, do not sell it for dollars. Leverage it. Borrow against it. Trade it for land. Trade it for a business. But do not trade it back into the burning building of the fiat system. The $17 billion signal this morning was the flare gun. It lit up the night sky and revealed the battlefield. And what we saw was a banking system in full retreat. They have abandoned the fortress of sound money. They are burning the furniture to stay warm. You have the metal. You have the position. You have the patience. The game is rigged, yes, but for the first time in history, it is rigged in your favor. The Fed has guaranteed your upside by guaranteeing the inflation needed to save the banks. The ghost week is ending. The reality is beginning. The $100 wave is unstoppable, and you are riding it. I am John A.G., and the Silver Squeeze has only just begun. Remember to like, subscribe, and share the video. See you on the other side.